Did you know that giving away your crypto can actually save you a significant amount on your taxes? It's true, but the IRS views these transfers very differently depending on who gets your digital assets. Whether you're sending Bitcoin to a friend or donating to a charity, the tax rules are complex, and getting them wrong can cost you. In this video, we're going to break down everything you need to know about crypto gifts and donations for the 2026 tax year. You'll learn how to distinguish between them, understand the tax implications for both givers and receivers, and discover powerful strategies to optimize your tax savings. We'll also cover the crucial documentation and reporting requirements to keep you compliant. Let's dive in. First, let's clarify a crucial distinction: crypto gifts versus crypto donations. The IRS doesn't treat all giveaways equally, and this difference is key to your tax strategy. A crypto gift is when you transfer digital assets to an individual, like a friend or family member, without getting anything in return. Think of it as passing on wealth. A crypto donation, on the other hand, is a contribution to a qualified charitable organization, like an IRS-recognized 501c3 entity. This distinction is critical because gifting crypto generally doesn't give you an immediate income tax benefit. But donating crypto, that can unlock powerful tax deductions, helping you lower your tax bill while supporting a cause you believe in. Understanding this fundamental difference is your first step to smart crypto tax planning. Since the IRS treats crypto as property, gifting crypto follows rules similar to gifting stocks. Good news for givers: the act of transferring crypto itself is not a taxable event for capital gains. So, if you bought Bitcoin for $1,000 and it's now worth $50,000, you don't pay capital gains tax on that $49,000 appreciation when you gift it. Your main concern is the federal gift tax, but don't panic. Most gifts won't result in actual tax payments thanks to two generous exemptions. First, the annual gift tax exclusion. For the 2025 tax year, you can give up to $19,000 to any number of individuals without any gift tax consequences or reporting requirements. You could give $19,000 of ETH to your sister and $19,000 of SOL to your friend, all without filing a gift tax return. Second, if you exceed that annual exclusion for a single person, you'll need to file Form 794 to report the excess. But you likely still won't owe tax. Why? Because that excess simply subtracts from your lifetime gift and estate tax exemption, which for 2025 is a massive $13.99 million per individual too. You'll only pay gift tax if your total lifetime taxable gifts go beyond this huge threshold. Now, what about the person receiving the crypto gift? Great news for them too. Receiving a crypto gift is a tax-free event. The recipient doesn't report it as income and owes no tax upon receipt, regardless of the value. The tax implications for the receiver kick in later, when they decide to sell, trade, or spend that gifted crypto. At that point, they need to calculate their capital gain or loss. To do this correctly, they need two crucial pieces of information from the original giver. First, the original cost basis, which is the giver's original purchase price for the crypto. And second, the original acquisition date, which is when the giver originally bought the crypto. The recipient inherits both of these. For example, if your friend gifts you one BTC that they bought 2 years ago for $10,000, your cost basis is $10,000 and your holding period is 2 years. If you then sell it for $60,000, you have a $50,000 long-term capital gain. This is why knowing the giver's history is absolutely essential for the receiver's future tax calculations. Donating crypto to a qualified charity is one of the most tax-efficient strategies for crypto investors. Here's why. When you donate appreciated crypto that you've held for more than 1 year, you can get two huge tax benefits. First, you avoid paying capital gains tax on the appreciation of the crypto you donate. That's right, you don't realize that gain. Second, you can deduct the full fair market value of the crypto at the time of the donation, subject to certain adjusted gross income limits. According to IRS publication 526, deductions for donations of appreciated property like crypto held over a year are generally limited to 30% of your AGI3. The holding period is absolutely crucial here. If you've held the crypto for more than 1 year, you can deduct its full fair market value. But if you've held it for a year or less, your deduction is limited to your original cost basis. This makes donating long-term holdings far more advantageous. Imagine you want to donate $50,000. If you sell $50,000 of BTC you bought for $10,000 and then donate the cash, you'd first pay capital gains tax on your $40,000 gain. But if you donate the $50,000 of BTC directly, you avoid that capital gains tax entirely and still claim a deduction for the full $50,000. Talk about a win-win. To sum it up, choosing between gifting and donating crypto depends entirely on your financial goals. Let's look at a quick comparison. For both gifting to an individual and donating to a charity, the giver generally realizes no capital gains tax on the transfer itself. However, for a tax deduction for the giver, only donations offer that benefit. With donations, you can deduct the fair market value if held over 1 year or cost basis if held for less, subject to a GI limits. For the recipient's tax basis, an individual inherits the giver's original cost basis and holding period. A charity, being tax-exempt, doesn't pay capital gains when it sells the crypto. The primary benefit of gifting is transferring wealth within limits, while donating aims to reduce your taxable income and support a cause. And finally, for IRS reporting, gifts exceeding the annual exclusion require Form 709-4, while non-cash donations over $500 require Form 8283-5. As you can see, the path you choose significantly impacts your tax outcome. Proper valuation and meticulous documentation are absolutely essential for IRS compliance, whether you're gifting or donating. The IRS requires you to use the fair market value, or FMV, of the cryptocurrency on the exact date and time of the transfer. As outlined in IRS Publication 561, the FMV is simply the price that property would sell for on the open market SIX. For actively traded cryptocurrencies, this usually means taking an average of the high and low prices on a major exchange at the time of your transaction. To support your gift or donation, you need to keep detailed records, including the crypto's name, the date and time of transfer, the number of units, the FMV per unit and total FMV, transaction hashes, and wallet addresses. For donations, you'll also need a writ acknowledgement from the charity for any contribution of $250 or more 7. And for donations over $5,000, a qualified appraisal is required 8. Manually tracking all this can be a nightmare, but this is where tools like dTax come in. dTax can automate this entire process by integrating with your exchanges and wallets. It pinpoints the FMV of your assets at the time of any transfer and maintains a record of your cost basis and holding periods, simplifying tax time. Checkout.com, it's open source and free to start. Filing the correct forms with the IRS is non-negotiable. For crypto gifts, if you give more than the annual exclusion amount, which is $19,000 for 2025-4, to any single person, you must file IRS Form 709, the U.S. gift and generation skipping transfer tax return. Even if you don't owe gift tax because of your lifetime exemption, filing Form 709 is mandatory to report the excess. This ensures the IRS tracks your lifetime exemption usage. For crypto donations, if your total non-cash donations, including crypto, exceed $500, you'll need to complete and attach IRS Form 8283, non-cash charitable contributions, to your tax return 5. This form provides detailed information about the property donated, its fair market value, and the charity receiving it. Proper and timely filing of these forms is crucial to avoid penalties and ensure your tax benefits are recognized by the IRS. Don't overlook these steps. Let's answer some common questions about crypto gifts and donations. First, can I gift crypto to multiple people without paying tax? Yes. For 2025, you can give up to $19,000 to as many individuals as you want, tax-free and without reporting one. It's per recipient, not per giver. Second, what if I donate crypto I've only held for a few months? If you've held it for a year or less, your deduction is limited to your original cost basis. not the fair market value. This is why long-term holdings are more beneficial for donations. Third, does the IRS really track these small transactions? While the IRS might not audit every small gift, they do have increasing visibility into crypto transactions, with proposed reporting frameworks like CARF and DC8. And current broker reporting, it's always best to be compliant, no matter the size. So, there you have it. A comprehensive guide to crypto gifts and donations for the 2026 tax year. Remember, understanding the distinction between a gift and a donation, knowing your annual exclusions and lifetime exemptions, and meticulously documenting everything are crucial for maximizing your tax savings and staying compliant. Don't let tax season catch you off guard. If you found this video helpful, please give it a like, subscribe for more crypto tax insights, and hit that notification bell so you don't miss our next video. Thanks for watching, and we'll see you in the next one.